Ever hear terms like pre-sale, seed round, and pre-IPO and feel like your head is spinning? Well, you're not alone. Today, we're going to cut through all that jargon with a really simple visual guide to how startups and crypto projects actually get their money.
You know, when you see the headlines about fundraising, it can feel like you're trying to decode a completely different language, right? Let's cut through that noise and see what's really going on behind all these fancy names.
So you've seen these terms thrown around everywhere. And yeah, they all involve raising money, but they represent fundamentally different stages with totally different rules for very, very different kinds of projects.
And this right here, this is probably the most important thing to get. We're not just comparing terms, we are literally comparing two entirely different universes. On one side, you've got crypto tokens, on the other, traditional company shares. Let's break down why that matters so much.
All right, so let's start at the beginning. We're going to define each of these fundraising stages one by one and really figure out who's playing and what they're trying to accomplish.
Okay, first up, the pre-sale. The easiest way to think about this, it's kind of like the crypto world's version of a friends and family round. The whole point is to get tokens into the hands of those first true believers, to kickstart a network and, reward them for taking a massive risk.
Now this is where it gets really interesting. Look at this allocation. Unlike a traditional company, a huge piece of the pie, the project's tokens, is often just set aside for the community. That is a completely different mindset about who owns and participates in a project.
Okay, next up, we've got the seed round. Now this is your classic starting line for a tech startup. It's that first real shot of cash that takes an idea from, a drawing on a napkin to an actual company with a real product, a team, and a fighting chance to find customers.
And just to put that into perspective, that $3.5 million, that's typically supposed to give a brand new company enough runway, say 12 to 24 months, to really prove their idea works before they have to go out and ask for more money.
And last but not least, we have the pre-IPO round. Okay, so at this point, we are not talking about a scrappy startup anymore. This is a grown-up, established business. This is where the big guns come in. We're talking mutual funds, hedge funds, all wanting a piece of the action right before it hits the public stock market.
All right, so we've got the definitions down. Now let's really get into the core of it, the massive divide between these two worlds, crypto tokens and good old-fashioned company equity.
Okay, so this is absolutely the key difference. When you buy equity, you own an actual slice of the company. You have a claim on its stuff, its profits. But a token? You're usually buying something else, a way to use a network or vote on its rules, not a share of the company that actually built the thing.
And wow, this table really lays it all out, doesn't it? I mean, look at the difference. The legal rules, who's even allowed to invest, how fast you can get your money out. It's like night and day. Equity is this well-paved road, and crypto, well, in a lot of ways, it's still the Wild West out there.
Yeah, this timeline is pretty stark. Think about it. A seed investor might be waiting a decade to see a return on their money. A pre-sale token buyer, they could be trading their tokens in just a few months. That massive difference in timing creates completely different incentives, different risks, and different kinds of investors.
And this quote from Coinbase just nails it. As a token holder, you might get to vote on things like protocol fees, but that is so different from being a shareholder who gets to, say, vote for the board of directors. It's about having influence, not actual ownership.
Okay, so we've covered the big picture differences. Now, let's roll up our sleeves and get into the nitty-gritty, the actual mechanics of how these deals are put together.
So, vesting. The whole point is to make sure people don't just take the money or the equity and run. In the startup world, that 4-year schedule with a 1-year cliff is basically the gold standard. But in crypto, the timelines are way shorter and way more creative, all designed to stop early investors from dumping their tokens and crashing the price on day one.
You know, trying to put a price tag on a brand new project is always going to be more art than science. For startups, investors look at the team, the size of the market, but for crypto, man, it's a whole new language. You've got metrics like FDV, that's fully diluted valuation, which tries to guess the future total value, and TVL, or total value locked, which is all about how much money is actually being used in the system. They're trying to value the network itself, which is a totally different ballgame.
So, we've walked through all these differences. The big question is still hanging in the air, right? How does a founder, or even an investor, figure out which path is the right one for them?
And look, the key thing to remember is this. One of these isn't better than the other. They're just different tools for different jobs.
If your project absolutely needs a huge, hyped-up community from the get-go, a pre-sale might be your best bet. But if you're building, say, a business-to-business software company, then a traditional seed round is probably the way to go.
And really, that's what it all boils down to. What's the goal here? Is it ownership or is it utility? Is it about building a private company or a public community? This isn't just a choice about how to raise money. It's a philosophical choice about the kind of thing you're trying to build. And as people make these choices, they're not just funding projects. They're literally deciding what the future of tech and finance is going to look like.